Hey, welcome. So, as a mortgage loan originator, you already know the deal, right? Not every borrower is a perfect fit for a conventional loan. So what do? How do you handle the world of subprime mortgages? Well, in this explainer, we're going to break down everything you need to know about subprime underwriting so you can lend with confidence and with integrity.
This is really the core question, isn't it? It's the one every single MLO has to be able to answer. And it's not just about pushing a loan through to approval. It's about seeing the potential problems before they happen for your client and for everyone involved.
To keep things really clear and simple, we're going to frame this whole thing as a risk assessment checklist. Just think of it as your step-by-step guide to making smart, compliant, and ethical decisions every single time.
All right, first up on the checklist, we got to understand the borrower. Let's really dig into the common characteristics of a subprime applicant.
So, a subprime borrower, they're often going to have at least one of these traits, maybe more. You're looking at things like a high debt-to-income ratio, maybe a credit history that's a little rocky with some late payments. They might not have a lot of cash left over after closing, or maybe their income is kind of tough to pin down. Think gig economy work, that kind of thing.
Now, pay really close attention to this number, 43%. Seriously, burn it into your memory. This is a super critical line in the sand for the debt-to-income ratio. Once a DTI goes above 43%, it often boots that loan right out of the standard qualified mortgage, or QM category. And that means you have to take a much closer look.
And that leads right into a huge part of your job. Look, your role isn't just to find any loan that'll get approved. It's about finding the right one. You have to resist that temptation to steer someone into a risky product just because it's technically possible. It is all about suitability. Okay. Next up on our checklist, let's analyze the actual loan product, because, as we all know, not all mortgages are built the same.
Keep your eyes peeled for these 5 features. You see interest-only payments? That could lead to some serious payment shock down the line. Negative amortization, where the loan balance actually goes up? Whoa, that's incredibly risky. Balloon payments? They just create this huge refinancing gamble for the future. And of course, sky-high fees or a really high loan-to-value ratio can also be warning signs. Each one of these just adds another layer of risk to the pile.
And this is where your responsibility as an MLO gets really serious. When you see these kinds of features, it's your signal to pump the brakes and slow way down. These loans demand extra work, totally crystal clear disclosures, and a lot of times, mandatory counseling to make sure the borrower really gets what they're signing up for.
All right, let's move on to Section 3 and talk numbers. We're going to dive into the nitty-gritty metrics you use every single day to actually measure risk.
At the very heart of all this is the debt-to-income ratio, DTI for short. It sounds technical, but it's a really simple and really powerful formula. You just take all of a borrower's monthly debt payments and divide that by their gross monthly income. That's it.
Let's just walk through a quick example so it clicks. Say someone makes $6,000 a month. Their total debts, including the new mortgage payment, add up to $2,700. You do the math, and their DTI is 45%. And remember that 43% number we talked about? Well, this loan is over that line, which automatically flags it as a higher risk.
But it's not just about DTI. You have to be a bit of a detective with that credit report. Look for things like FICO scores under 620, a whole bunch of recent credit inquiries. That can mean someone's in financial trouble. And of course, the big ones, derogatory events like bankruptcies or foreclosures.
And here is a huge compliance point you cannot forget. For most standard loans, setting up an escrow account is usually optional. But for something called a high-priced mortgage loan or an HPML, it's not optional. Escrow is absolutely mandatory for at least 5 years. That is a critical rule you just have to follow.
So, all of this brings us to the absolute core principle of modern lending. This is the big one, the ability-to-repay standard. It is completely non-negotiable.
Under the ability-to-repay rule, you have a legal duty to make a reasonable, good-faith decision that the borrower can actually afford to pay back this loan. This means you have to verify and document a whole bunch of stuff. 8 key factors, from income and employment to credit history and all their other debts. You can't just take their word for it anymore. You have to prove it on paper.
And listen, this isn't just about whether they can afford the payment today. You have to think about the future. If that loan has an adjustable rate or an interest-only period, what happens when that payment jumps up? Can they still afford it then? That's the real question you have to be able to answer.
Okay, let's bring it all home now. For this last section, we're going to connect everything we've just talked about directly to the SAFE Act framework. The stuff you'll actually be tested on.
Just think of this table as your ultimate cheat sheet for the SAFE Act exam. Understanding subprime borrowers, that's risk qualification. Knowing about risky loan features, that's mortgage product knowledge. Mastering DTI and credit, those are your underwriting calculations. And the ATR rule, that's the foundation of your legal and ethical duty. See? Every single piece connects back to being a competent, compliant MLO and to crushing that exam.
And that leaves us with one last, really powerful question you should be asking yourself on every single loan file you touch. Don't just ask if this loan is possible, ask yourself, is it suitable? Answering that honestly is the difference between being a loan originator and being a true professional.